Thanks for coming out and watching the oxymoronic Reddit Professional Show, where I showcase the best and worst of the internet. Here I comment on brilliant and hilarious comment chains regarding dumb shit on the internet for you to enjoy. Make sure to subscribe, hit the little bell button so that you get notifications every time we come up with a new video. Enjoy this week's show.
Sellers are still crazy. My on-site manager called me the other day telling me that a broker had contacted him and wanted to get owner contact, because they've got another MHP near ours that is for sale, and they are marketing for bids. I told him to give them my email, and send me an OM, because I'm in the market and I'd love to add more units to my belt this year. Talk to the broker. Here are the numbers. 430 units. 30% occupancy. Market rent is $375, according to the OM, actual is $350. Pro forma expense ratio, 50%. Going to market at 4.5 M. 430 multiply 0.3 equals 129 multiply 350 multiply 12 multiply 0.5 equals NOI of 270,900. 270,900 slash 4,500,000 equals 6.02 cap rate. Stabilized cap rates, 90% occupancy of 200 plus units, in the market is 4. The property is free and clear, owned by the same guy for 40 plus years. The broker's argument when I said, no, it's 10K per unit. I said, so, that's not how this works, you know this, I know this, and the seller should know this. I'll buy it at the right cap rate, 16.5, which is what I just bought my other property at with the same occupancy numbers, $1,650,000. I'm going to have to put another $2 million into it to get to stabilized occupancy. I told him, when the seller fails to get the offers he wants, and he is open to selling for what it's worth, call me. Or if he wants to get a higher price, then we can discuss some seller financing options. Or alternatively, if you find someone to buy his at that price, call me back, and I'll sell mine for the same valuation. What could this property be worth? For 30 units, multiply 350 market rent, multiply 12, annualized, multiply 0.7, 30% expense ratio, slash 0.04 cap rate, $31,605,000. Sure, buying a property for 4.5 M when it could be worth 3.2 M sounds like everyone's wet dream. But you are going to have put $2 million and 5 years into it. And if you don't have a team, or experience, or a 20-30 M NW, to be able to carry the expenses on this property for 5 years, it could ruin you. The carrying costs on 4M at 8% is $27,000 per month. This thing only has a $22,575 per month cash flow. So while you are throwing 2M at the rehab, you are still paying out $60K a month, and the absorption rate for that many units has to be there too. Lesson for newbies: know your market, know what prevailing cap rates, standard occupancy, and operating expenses are, and stick to your guns. Don't lose money on a wet dream. Lurker on this sub. This was an awesome explanation of an investment thought process. Fill me in on cap rate. Is that expected rate of return? Discount rate of cash flows? NPV. Appreciate any input. Cap rate is net operating income divided by the sale price. Gives you a very rough idea of how profitable the asset is less financing costs. Yup. Works the same as the dividend discount model applied to the annualized rent to calculate the gross market value. The applied capitalization rate is always subjective because it varies depending on how core the building is, the area, the type, retail, commercial, how worn out the building is, the vacancy rate, and you generally use comparables to have a baseline. Woot, there's a guy who caps. Yeah, we could talk for days about what should go into a cap, but most brokers don't care enough. They just get comps. Interestingly enough, my park as a recent purchase was a comp cap / market rent for this one. I laughed because the numbers were wrong on using my park as a comp. I feel like I understood most of your post and vaguely some of this additional info throughout the comments. Do you know of any decent videos online that discuss this to the level you guys are that you'd recommend? I don't do any of the podcasts or YouTube videos. It's all pretty simple math. What questions do you have? Pudding's comment just took it to the next step. I'm an individual that knows the math is simple, but understanding the inputs and origins of the simple math takes me repetition and application, through example. Not all videos / articles are great, so I like to ask those that are at full understanding if they know of sources they think do a better job at discussing the topic. I won't make you be my Google though if you don't know any offhand, lol. Yeah, he got into some pretty archaic stuff in that comment. Basically, he was talking about what an appraiser is going to consider when it comes to calculating the cap rate for the property. It's like comps on a SFH. If every house in the 0.5-mile radius has quartz countertops and you have granite, you could take a slight hit to valuation. In this scenario, roads, office buildings, sewer, and electrical systems would be the equivalent. I don't think it's possible to quantify the value of a quartz countertops over granite, just like it's hard to quantify the value of an office building for a park. Insurance will assign it a value, but since it's not a capitalized asset, does it really add value to the sales price of the park? I haven't read any books or seen anything that gets into those aspects other than an appraisal report. So I guess experience is the best teacher here. I like to think about cash-on-cash return for income properties. I agree, when I was buying smaller properties I focused on COC 20% minimum. But in this instance and in this asset class and at my current portfolio stage, growth, I'm looking for better returns in the short term. So there needs to be value add. When I settle into agency debt, the COC is irrelevant because I'm at an infinite return. In this instance I would do a 3-stage rehab. First stage would have PP plus 800K cap investment on a 16-month horizon. To get the pad repaired and bring occupancy up to 50%, and then I'd refinance likely for $6.6 million plus 1M cap EX. If I buy at the 4.5 and have the 800K, I've got 5.3K into it, 30% is my cash, 1.6M. 7.6M at 30% LTV if have a new loan balance of 5.3M giving me all my dollar back, and a COC of 100%. Phase 2 I'd shoot to have 325 homes and be targeting $11 million plus 1M capex funding, for a LTV of 8.4M kicking me back another 1.4M, giving me close to another 100% COC. Last into agency debt 80% LTV, I'd layer a low income grant on top of it to push LTV to 85 to 90% at 3.4M. Just about 2.9M, and clear about $20 million tax free. At that point the actual cash flow is a mere pittance compared to the tax-free dollars I've already taken out. I could hold forever, and use the rest of the cash to either keep growing or just buying already stabilized properties for monthly cash flow. I appreciate your investment discipline. But if this deal is what you're describing, you could find an equity partner or PE company that would get involved with relative ease. I could, theoretically, if I had the experience and the track record of such a big turnaround. I'm building that now. It would be an interesting project, but in the current economic climate, I think it's safer to stay to the right numbers and not overpay for future benefits. I don't disagree with your mentality. All I'm saying is it sounds like there's a lot of meat on that bone. Trying to think of a way you could get involved with your lack of experience and reduced exposure to your equity. You could potentially partner with a more development/construction type of company that'll bring the experience and a small amount of equity to take the property down. Let them take the driver's seat and reduce your personal equity exposure. Yeah, there are a lot of ways I could take this down if I felt I was ready. Already in the process of turning a park less than 20 miles away from this one around, and I don't think I could mentally handle the anxiety of doing 2 at a time. Get one done first, finish building the systems and then keep moving. Raise debt. Instead of working with regular financing, raise debt partners at agreeable terms and convert to equity. Use cash program to reduce infill costs, and just carry the note, leaving just site development costs up front. Find out how many parcels there are, buy, split parcels, and carve out 3-4 separate parks. Do a delayed infill, fix expense ratios and infill through cash flow. This was an interesting read. Thanks for posting some of the numbers and specifics. I work in CRE in an area that is related to property valuation. I've never worked directly on the investment side and I know very little about MFP specifically, so take everything I say with a grain of salt. I'm only going off the numbers you provided. I would be interested to see the feedback you would get if you made this post on r/commercial real estate. Some of the folks there will be more experienced with deals of this type and size. That being said, when our clients, who are usually institutional owners looking at acquisitions in the $20 million to $200 million range, are pricing value add or redevelopment deals, they are not basing their purchase price primarily on in-place cash flow, which is what you would be doing by applying a cap rate to current income at 30% occupancy. Sure, buying a property for 4.5M when it could be worth 3.2M sounds like everyone's wet dream. But you are going to have put $2 million and 5 years into it. And if you don't have a team, or experience, or a 20-30 MNW, to be able to carry the expenses on this property for 5 years, it could ruin you. The carrying costs on 4M at 8% is $27,000 per month. This thing only has a $22,575 per month cash flow. So while you are throwing 2M at the rehab, you are still paying out $60K a month. And the absorption rate for that many units has to be there too. Ironically, I think the thought process you describe here is not too far off from how they would analyze something like this. All redevelopers are buying something for $X that could be worth $Y after construction. In other words, to use your numbers with a more straightforward example, a developer might buy land for $4.5 million and then build a structure for $2 million. Before construction began, they put together a pro forma that estimated the time to lease up after construction completes, absorption rate, and the property value once leasing is completed, $32 million. They add in carrying costs to their DCF model at $27,000 per month over the period. In reality, there will be additional carrying costs, just using your numbers. The question becomes, is it worth investing the costs, i.e. purchase price, construction cost, carrying cost, time value of money, etc., to get the potential reward, i.e. cash flow at stabilized occupancy and maybe selling it for $32 million? If it's not worth it a purchase price of $4.5 million, what price would work is usually the next question. Price is the variable that can be changed in the model. To answer these questions, professional investors often use modeling software to make a DCF model and calculate the IRR for the project. Google Argus software. IRR is much more meaningful for this type of investment than cap rate based on property's current income. Honestly, the numbers you describe might be very attractive for a developer/value-add investor. I cannot say for certain because in reality, you are leaving out a lot of other costs in your post and I do not know if your other assumptions are correct. If you don't have a team, or experience, or a 20-30 MNW. Here is the key statement. Just because you do not have the capital or experience/expertise to do this deal does not mean the seller and broker are crazy. Based on the info you provided, this could be a good value-add deal. It would be risky, of course, but that is why the potential investment returns should be very high. This type of deal seems to be outside of your risk comfort zone, which is fine. All good points. And I totally agree with your evaluation. I tucked in that one line to hand wave that a bigger fish is who is interested in something this size. It's why I'm playing sub 200 pads, because it often doesn't have these calculations. I'm working my way to these types of deals, but this was targeted at the kind of people who read this sub, that tend to be on the smaller end, thinking about moving up to the next level. Thanks for sharing your insight and process. Cheers. More and more owners like selling the privilege of adding value. As though you owe them a premium for having a dilapidated property that needs tons of work. Yeah, and people are paying for it because they are chasing returns, doesn't matter how small, because instead of being a business they are just a conglomerate trying to send returns back to shareholders. This was a great post. What is your background? How did you get into the MHP business? Few questions about the property. Hopefully the seller and agent wake up for you. Is the 350 lot rent? What % of the park's homes are park owned? Who pays what at the park? Utilities, cable, mowing, etc. How does the water work in the park? Submetering of water and sewer. How are you considering the deferred maintenance cost? As a start, could you go through the expense items provided by the seller and see what is lower than it actually should/will be? 30% occupied is a great opportunity but will take work. Can't believe MHPs are selling at a cap. WTF is going on? Edit, 6 cap. Is the 350 lot rent? Yes. What % of the park's homes are park owned? 0. Who pays what at the park? Utilities, cable, mowing, etc. Utilities/cable, resident. Trash, usually dumpster, landscaping, snow removal, pest control, roads, park owner. How does the water work in the park? Submetering of water and sewer. It's a pain in the ass, but it works as triple net. I get a master bill, have a third-party collections, get a check 45 days later. How are you considering the deferred maintenance cost? $2.5 million capex spend breakdown would be $250K for the sewer/water upgrades, $250K for electrical upgrades, $250K for roads/pad repairs, $1.75 M for infill. Pardon my ignorance, but what is infill? Thanks for sharing all this, it's an interesting read. Infill would mean there are all these empty spaces already developed, I'm just filling them in. Infill.
If you enjoyed this week's effective way to waste time, hit that like button and subscribe for more content like this. If you are enjoying the series, leave me a comment below. A special shout out to the content creators. You frickin' rock.